Good morning. If it's Friday, 10 o'clock, it's time for Accounting 230, Financial Accounting, course number 40998. And we're about to go into a new chapter. And I am now waiting to see if anybody joins us today. Pray tell, who could this be? Nicole? How are you doing? Nice to see you this morning, huh?
Yeah, I'm doing good. How are you?
I'm doing well, I am now going to share the screen. And we are in a totally new chapter today, huh? The appendix. We have to take our appendix out. So let's slide this thing the way I like. Okay. Hey, this is totally new stuff now. We're going to, we're getting into a real different area here. We're talking about investing in other companies, Nicole. Investing in other companies. Microsoft has a lot of money lying around. They can go out and they can buy stock in another company. They can issue a bond if they want to earn some interest. So here are three categories. You're going to see some new terms here, and we're going to just have to work our way through these rather arcane or esoteric rules, if I may say that. A company invests in another company. They may do so just to earn a passive investment. And that passive investment has a very, very specific term, has a very specific meaning that influences how we treat it.
Mm-hmm.
They could influence the other company's activities if they buy enough stock or if they buy the majority. A passive investment is ownership of less than 20% of the stock. Okay. 20% or less, or under, let's say it this way, under 20%, it's called a passive investment with specific rules. If you own 20 to just under 50%, you are said to have significant influence. And significant influence is an accounting term with specific rules. And then the third layer is if you buy more than 50%, if you own 50.00001 of the company, you now have a whole new company. It's yours, and there are rules that apply to the consolidation and the organization of the new company. So passive investments in debts. Let me say it this way. All debts are passive. And that's just, and we're not going over the bonds again right now, but understand what a passive investment is. It's an investment where you have no influence. You're totally independent from the company. For example, you buy a bond in Coca-Cola, you buy $1 billion worth of Coca-Cola bonds. Okay? And you don't like the way Coca-Cola is running the company. If you go to Coca-Cola and say, if you guys don't straighten out, I'm going to sell these $1 billion of bonds. I'm going to drop them back on the market. Coca-Cola is going to laugh at you. They're going to say, who cares? That's a debt. You can do whatever you want. It has no influence on us. Okay. So under 20%, no influence. And that's where we're starting now. The only thing we're going to do with debt in this chapter is understand that debt is a passive. Okay.
Okay.
You can buy stock that's passive as well. And we're going to go over that in a moment. Here are some rules about the significant influence, over 20, below 50. The ability of the investing company to have an impact on the company's activities. If you own, say, 44% of a company, well, you're said to have significant influence, because I might own 1%. Someone else might own 1%. With 44%, it wouldn't take long for you to get together with four other shareholders and come up with big influence, okay?
Mm-hmm. Okay.
Investment in stock for control, over 50%. When that happens, you have a brand new company that must be possibly consolidated. And the reasons you take over another company, besides hoping to make money, is You could be looking for vertical integration, vertical, horizontal, or my favorite term, operational synergy. And we'll get to that at the end here. I call your attention to this grid here. Types of investments and accounting methods. Debt, we're not even going to talk about. We're going to skip those slides. But I'm sure there's going to be a question or two along the lines of true or false, a bond can be other than a passive investment. It's just passive. That's all you need to know. Okay. Debt is passive. Now, here's what we're talking about. If we invest in stock, we will treat it under what's called the fair market value method. And we'll see that in a moment. Significant influence uses what's called an equity method, and control is just that. You have a new company. So I'm going to skip everything in this chapter on debts, because what we're going to learn with passive stock investments holds for bonds. The only difference is you amortize a bond, you don't amortize a stock. And I think we've had our fill of amortizing, I would think. All right, here we go. As far as I'm concerned, this is where we're going to start the chapter in some detail, okay? Passive stock investments under 20%, the fair value method. We buy 100 shares of McDonald's at $1 a share, just to make up a scenario. And we debit investment in McDonald's or trading securities or whatever, credit cash. Throughout this entire course, since we began in September, I've pounded into you guys that you never, ever raise the price of an asset, and that it's always carried at its historic value. And we had examples, that person who was lucky enough to buy land in Santa Barbara 50 years ago for $100,000 now owns a property that's probably worth $20 million. You can't write that up. Here is an exception. Here's the first time you are going to look at an asset and say, this asset is worth more money. And I'm going to show an unrealized gain, at least, on the new market value. Okay? So that's where we're going here. We're going to actually update the market cost of our asset, whether it goes up or down. Investment carrying amount is adjusted to the current market. Now, passive investments we know are under 20%. They have a further breakdown. They are either trading securities or AFSs, available for sale investments. What this means, Nicole and everybody, is you identify that this is a trading security. In other words, you're telling the world that we are going to actively trade this for potential profit on a short-term basis. We might buy it and sell it. We might do it over again, okay? That's a trading security. The AFS, available for sales, you're going to treat this more passively. You're going to hold this for a while. And the reason I think you have to let the world know this is because they have a right to know what your investment strategy is. It helps the investor understand what you're doing, okay? I'm not going to go over the rest of this grid here because we're going to get to this in detail. Let me say this. Treasury securities and AFSs, the treatment is exactly the same except for one journal entry, okay? So let's see what we have here. Fair value, we know what that means, what it would take to sell it. Now let's talk about the reason why they use this exception. Why are they doing this with a stock, raising the price on your balance sheet, but not land? Well, land, you never know exactly what it's worth. You know, it's worth more. Same thing with a building, but you can't really put a firm number on it, okay? And things can change. There could be an earthquake, destroys that land. So with this, though, you can look and see what your investment is worth every split second of the day. It's measured. It's on quoted prices in the stock market. You buy Coca-Cola today for 50 and you want to know what it is 3 days later, it'll take you 2 seconds to dig it out on Google.
Mhm.
So you always know exactly what the price is. There's no question about it. And these estimates are based on other observables, what the stock market says, and the company's own estimated factors. But basically, you always know what your investment is worth. So the accounting convention, the GAAP principle here is with these kinds of investments, we can restate our balance sheet, okay? So let's start with the first of the two. The first of the two passive investments. Graham Holdings acquires 15,000 of the 100,000 shares of iNews on the open market, paid $10 a share. Graham has no influence over this place and does not plan to sell the shares in the near future. Or is this a trading security or an AFS? It's an AFS, and you just got to start understanding that. And
Mhm.
plus, you have a hint at the top of the page says AFS, okay? Available for sale. Okay, I wish they do that on the test, right?
Yeah.
So, I mean,
Type the answer somewhere in there.
we do have a suggestion box. Graham Holdings does not plan to actively trade. They will be held to a return. They will be held to earn a return on the investment funds. So this is clearly an AFS, okay? Now, let's see what we have here. They bought this investment for 150,000, 15,000 shares times 10. Here we go. That's a current asset called investment in available for sale securities in your credit cash, okay? I called it a current asset. I guess it could be otherwise, but I think of these as current assets. Okay, so that's not too tough.
Yeah.
Now, here we go. Now it's 6 months later, whenever.
Mhm.
Graham Holdings receives a dividend from iNews. How nice. Got a dividend. One share, 15,000. I bet you know the journal entry is going to be a debit too.
If they receive cash.
Yes, let's get with the program, Nicole. Yeah, cash.
I was just making sure I'm recorded on this. I make sure I read it right.
Yeah, and it's
Debit
called
to
dividend
cash.
income, probably. Okay, there you go. So, in other words, we're totally third party. We have nothing to do with the company. We're totally independent. Okay, that was
Okay.
July 2nd. That was nice. Boy, that's a nice investment return too, huh?
Yeah.
They got a what they get a dividend of how much? $15,000 dividend. Got a 10% dividend. What a great company. Okay, now we're at the end of the year or the end of the month. Oh, look what happened. The market value of our shares went down 20%. My goodness, went down to $8 a share. So we have to understand how much money we've lost on paper. And I don't think that's a secret. We paid $10 a share.
Mhm.
It's down by 30,000. Now it's at 12 or $8 a share. So we have to write an entry for 30,000. And here are some new items you've not seen before. So let's take a look at this. The unrealized holding loss is reported in the equity section as accumulated other comprehensive income. Let's set that aside. Let's look at our journal entry. We are going to debit an account called net unrealized losses, gains, or gains and losses. And it is an equity account. You have a new equity account. So our equity has grown from the first day of class where it was just cash invested in the business. Then we introduced retained earnings, and then we got into preferred stock, common stock, paid in capital, treasure. Say hello to a new one, okay? This is an equity account. So by debiting it, we're reducing it. And we understand that, I think.
Yeah.
Well, our investment, we put it on the balance sheet at 150. Sad to say, it's no longer worth 150. So that's our credit. Okay. This is balance sheet,
Mm-hmm.
balance sheet at this
Okay.
point, okay? That's why they call it unrealized. Hey, we go to the next year. Now the market value of iNews has gone from 11, it's gone up to 11. My goodness, pretty volatile. So now we were holding it now at 120, right? We started at 150.
Mm-hmm.
Just the prior year, wrote it down to 120. So here we go. Now we have a $45,000 gain. So our journal entry is going to be the same two accounts
But
in the
opposite,
opposite
right?
sign control. Yeah.
Right.
Here we're debiting the asset, which now went up 45,000,
Mm-hmm.
and we credit the equity. So I don't think this is too tough to follow.
Yeah.
Again, you're going to have to understand the slightly different treatments between the two, the AFSs and the trading securities. Now they
So
finally, pardon me?
trading is if they're going to like reinvest it in a short amount of time. Is that
Yep.
what it is?
Trading securities means they're likely to sell it pretty quickly.
Okay.
They're probably gonna get rid of it in the next year. Their hope is to make a quick strike.
And then available for sale is that they don't have.
They're
any
not
plan on
likely to
doing it.
sell it in the near future. That's why they indicated that it could be other than a current asset. I think of these as current assets, but that's not quite correct.
Okay.
Hey, at the end of 2017, Graham sells it all for 13. Wow, it went from 10 to 8
So
to
11.
what was it, 11? So this turned out to be a pretty darn good investment, huh? They earned
Mhm.
almost 25% in 3 years. That ain't too bad. So they sold it for 195. The original cost was 150, right?
Mhm.
And the gain on the sale was $45,000. Where do you see the journal entry? Before we go to the journal entry, here's the tricky part. And
Mhm.
here is the only difference between the two treatments, okay? When we sell this asset, we have to obviously take it off of the income statement. I'm sorry, take it off of the balance sheet, right? We're selling an asset. But don't forget, remember we had been hitting this account, the net unrealized?
Mhm.
We started off with 0, and then the stock went down 30, and the stock went up 45, leaving us with a balance of 15.
Mhm.
Clear on that?
Yeah.
That means we have to get rid of that 15 maybe. So look at our journal entry. It's going to have 4 lines. So let's take a look at this. And this 15,000,
Mhm.
you're not going to have this under trading securities. And we'll get into why. When you sell it, if this was a trading security, this number would not appear. And we'll talk about that in a little bit. So let's understand the journal entry. Well, we sold 15,000 shares for 13
Mhm.
cash. We must clear out this credit balance that's sitting in the balance sheet. It's an equity account. So that has to come out with a debit. We have now we're carrying it at 165,000. That was when it went up to $11 a share.
Mhm.
So we have to plug our gain or loss, 45,000. That's how you get the gain on an available for sale. Cash, debit or credit this account, minus whatever it was on the balance sheet at the time you sold it, and you squeeze that fourth number. Make some sense on that?
Yeah.
You look a little shaky, which is understandable.
I do.
But once you do a few things, and if you understand available for sale, you understand treasury stock with that one little glitch, and we're going to go over that.
Okay.
I said treasury stock. Put a
I
quarter,
know.
put a quarter in a jug every time I make a mistake and say treasury stock. Trading securities. Trading securities, huh? Graham, look what they did. Wow, they made the same investment, okay? Only this time they declared it to be a trading security. It is a trading security. They have no influence and no plans to, and they plan to sell in the very near future. Trading security. So your journal entry is exactly the same, except we're not calling it an AFS. The investment is a current asset. So you see your journal entry here, Nicole? Debit and investment in TS, not an AFS, right?
Okay.
All right. And remember that the investment paid us a dividend. Again, that's pretty easy. Got a dividend check in the mail, that lovely 10% dividend, debit cash, credit the revenue. Okay. And now it went down by our famous $30,000, just like it did before, right? We have to recognize that loss and look at the journal entry. Does that journal entry look familiar to you?
Yeah, isn't it the same one as before?
Yep, exactly. Good. I'm glad you picked that up. Exactly right. It's the same exact journal entry as before, except we're calling it a different account, investment in a TS, trading security. So the asset account goes down with the credit, and so does the equity account because we lost money. So our net worth has gone down by 30 because we lost some of our assets. It went up. It went up. And here is where we said to ourselves, well, we wrote it down to 120. Now it's 165. Here's our gain, right? 45. Would you agree that's the same exact gain as before? Okay.
Yeah.
So we have to increase the investment by 45 and increase the equity as well. So far, we've not touched the income statement. Okay. Now we sold the stock for $13 a share. Here is the difference in the treatments between a trading security and an available for sale, security available for sale. Trading security. Look at this here. Remember this account? The net unrealized? Notice this. It started off as 0, right? And they had an unrealized loss of 30. Look what they did with it at the end of the month here. They closed it out. In other words, with a trading security, you will have a 0 balance in the net unrealized. And that 0 balance, when you remove that $30,000 from the call, that goes into the income statement each year. So the big difference between the two is in trading securities, you put these annual gains or losses into the income statement. You don't do that with the SARs. And there's a real good page in your book where they lay these out, these journal entries out, line by line, and you'll start to see the difference. So remember I told you we would not see that $45,000 number?
Yeah.
In the journal entry?
15,000, right?
What's that?
The 15,000 and 45,000.
Yeah, that's gone. Yeah. Yep. The 15 went out to the income statement in 16, and the other one went out in, I guess, 15 or whatever.
Okay.
So you got a little bit of a feel for the difference between the two?
Yeah.
You know, it's just a feel right now. When, I don't know if you tried to read these chapter yet or tried to do any of the homework or exercises, but you're getting a pretty good look at the difference between these two types of investments, okay?
Okay.
And here they're going comparing trading and available for sales. This to me is a little overblown. You can go through this. But trading securities, sales price, book value. I mean, it's up to you if you want to look at this. I find this a little more pedantic and a little tough to swallow. Okay, so you just learned about investments under 20%. They use the fair market value method. Here we go. Investments for significant influence. They're going to use what we're going to call the equity method. It's presumed that the investment was made as a long-term investment. Is that what that says there? I can't see it.
Mm-hmm.
Yeah, long-term investment.
Yeah.
The bar is blocking me.
Yeah.
And I find if I reduce the bar, I really foul myself up. So we're going to have to live with that. Right? Significant influence. Now, you are not going to record gains or losses. They have a completely different treatment.
Significant.
And the investment carrying account is adjusted for dividends received and a percentage share of the investee's income. The way I like to get the significant influence across is what happens to the parent company happens to the affiliate. And that's what we're going to call these. That's what we're going to call ourselves, an affiliate. An affiliate. Okay. This is interesting. Look at this. We got a dividend. Remember that $15,000 check we got? Well, under passive, since we had nothing to do with the company, we debit cash and we credit income. Look what happens here. When we got that check, it reduced our investment. How come, Nicole? We worked a little bit last night. Do you remember what do you always debit? What do you always debit when you issue a dividend? We're back in the prior chapter.
You debit?
Whether it's a stock dividend or a cash dividend.
Retained earnings.
Exactly. Retained earnings. And what happens when a company issues a dividend? They have reduced their equity, right?
Yeah.
So what happens to the parent company happens to us. We're going to end up debiting our equity here.
Oh, because we own more shares.
Yes. We're considered you're considered like part of the company in a way. If the company makes money, if the company makes $1 million, we get 20% of it. We're 25. Okay. Same thing if they lose money, we share in the losses. So this method is easier, I think, than the prior passive investment, as long as you kind of understand the rules here. Graham Holding bought 40% this time, $160,000, I suppose. No, they bought 400,000, not 40%. Not 40% of 400,000. Going too fast, huh?
One or the other, it's okay.
There we go. You guys all know what I'm talking about. Investments in affiliates. That's what we call it, affiliate. Are you familiar with that word, affiliate? You know where you hear that word? You might, if you're watching television, you might hear as a show goes off the air, you might hear an announcement. KEYT is an affiliate of ABC News in New York City. It's like a subsidiary, okay? You can't call it a subsidiary because it's not operating in terms of what the strict definition of a subsidiary. It's an affiliate. KEYT out here is run by ABC News, which is headquartered in New York City. We have KNBC in Los Angeles. That is an affiliate of WNBC back in New York, where I grew up in Rockefeller Center. 30 Rock, you've heard of that, right? 30 Rock. That's where NBC News is headquartered. That's why, that's where Saturday Night Live is, okay? So we are affiliates. That's what we call it. Affiliates. And I'm going to use one of my bad jokes. And I guess we got to give the rest of the class a trigger warning for another bad joke. When I was in grammar school, surprisingly, I was a bit of a wise guy.
Mm-hmm.
And the word affiliate came up, and then we had to spell it,
Mm-hmm.
And the kid in front of me spelled it. So they gave me the next word to spell. It was officiate. The word officiate, referee about. And the nun said, Robert, can you use the word officiate in a sentence? And even at the age of like 10 years old, I couldn't resist a bad joke. I said, yes, sister. I said, my uncle got sick from officiate. Anyway, they did not like that
I'm
type
gonna
of
tell
thing.
that to my father-in-law because
There
he
you
likes.
go. Father-in-laws love those jokes. Okay. Okay. So what do we have here? We have a $400,000 stake in this $1 million company.
Mhm.
Graham Holdings owns 40% of whatever their income is. So iNews, $500,000 in income. We get 40% of that. So take a look at this entry. Debit our investment. Our investment went up $200,000, right?
Yeah.
I'm sorry. I want to go back to this real quick. I must move my bar. Come on here. Oh, this thing is.
It would be nice if they made the slides where they were.
Yeah, you probably could.
Information.
Note.
From
Yeah, I just want to read this note. Graham Holdings credits equity in affiliate earnings. And here's the point I wanted to make. That's why I wanted to double check.
Mhm.
That account, equity in affiliate earnings,
Mhm.
what kind of an account is it? Revenue?
And equity. Or retained. No?
No, that's revenue.
Oh, why did you question me and confuse?
I don't know. This is what confuses everybody. Confuses the heck out of me sometimes.
Equity.
Equity in affiliate earnings is not equity. It's a revenue account, okay?
Okay.
The revenue does increase the equity.
Uh-huh.
But this goes right on the income statement there, okay?
Okay.
So that's a goofy little thing.
Okay.
And guess what? That's pretty easy, right? We get 40% of their income, so that's good. Now, here's what we were just discussing. When they paid $100,000 dividend, our cash went up, but our investment went down because a dividend, by definition, you are giving away part of the equity of the company. And that's why this gets reduced. Think of it this way. KEYT, Channel 3 here in Santa Barbara, is the same company as ABC News, as WABC News back in New York City. So all that happened here was a company wrote a check for $40,000 and basically paid itself, is the way I like to think of it.
So it's like if we take out of our savings account, right?
Yeah.
Like we're paying ourselves, but taking out money in a way.
Yeah, WABC in New York wrote a check to KEYT here. And when KEYT got the money, well, they're the same company, really, for accounting purposes here. So what happens to the parent happens to the affiliate. If the affiliate makes money, if the parent makes money, the affiliate makes money. If the parent issues the dividend, that means that the retained earnings goes down for both companies in the form of this investment account. Under the equity method, you report it as a long-term asset. It's increased or debited by the gains or losses, and the account is decreased by the proportional share of any dividends. At the end of the accounting period, we don't make any adjustments. And if we sell it or hang on to it, if we sell it, any gain is reported as on the income statement. They're calling it other income. I don't like the word other income, although it is. It's not operating income, right? That's what they should have said. It's not operating income. It's going to come below operating income. All right.
Okay.
Here we go. Well, we hurdled over 50%. We started with just a little bit passive, went up to significant influence, and now we own the company. We own this company. That company no longer exists. We can rename the company. We can fire everybody. We can do whatever we want. We can continue to let the company run on its own with the current management. We have all kinds of decisions, okay? This kind of makes me laugh. Controlling interest, mergers and acquisitions, okay?
Okay.
Let's start with vertical integration. Vertical integration means you are buying other companies in the same business, okay? It would be like Nordstrom's buys Neiman Marcus.
Okay.
They're in the same business. That is called horizontal growth. Okay, you buy similar businesses to take over their business and get access to their customers. Horizontal, same business. Vertical means you are buying other companies that might provide raw materials for you. For example, if Coca-Cola purchased a sugar plantation in Cuba,
okay,
that's an example of vertical. If Ford Motor Company bought Uniroyal tires, vertical. This is just worth a couple of points perhaps on the test, the difference between the two.
Okay.
Synergy. This is a buzzword, huh? Synergy. You'll hear these announcements made. We are proud to announce that we have merged with this other company, and we expect spectacular synergy. Synergy means 1 and 1 equals 3. And what I mean by that is my company is $1 million company. Your company is $1 million company. So you add them together, you got a $2 million company. But the synergy comes from I can run your company better than you're doing it. If I get access to your customers, you're no longer $1 million company, you're a $2 million company. That's the synergy. The idea that this is going to add to not exponential, but you're going to get a lot more value than the 1 million you put in. Okay.
Okay.
All right. So that's a small part of this. Controlling interest, mergers and acquisitions. Acquisition accounted for using acquisition, accounting, and consolidation. Can you translate that to me? I can't understand quite what they're saying. So we'll go on. Okay. A consolidation. Consolidation, you put two things together, right? You know, chocolate milk and, chocolate syrup and a piece of milk. That's a consolidation of two wonderful things, right? A consolidation is when one company buys more than 50% of the other, and they're going to run as separate businesses, okay? In other words, your decision on this level was, we're not going to touch you guys. Don't worry. We're not firing anybody. We're just your new boss. You guys run as you're going now. But you must prepare consolidated financial statements, meaning you do add the two companies together and present the total to the world. You're going to present the acquired company is going to continue to issue their financial statements. You'll issue yours, and you will also issue the consolidation. If you buy 100% of the stock, the consolidated financial statements look the same as if the companies had been merged. The point is, when you buy the company, you can consolidate it or merge it into one company. And the rules are here. A merger is when one company purchases all of the net assets of the other company and the other company goes out of existence. Hopefully nobody lost any jobs here. It just means that The reason I eventually got fired from Thomas and Betsy after a lot of years, I shouldn't say fired. What they did was in 1993, they called us all in to say that Thomas and Betts was being sold to a company called American Electric in Memphis, Tennessee, and that meant that all the operations in the offices were going to go to Memphis, Tennessee. And if you were unlucky enough to be working in where I was in California, in New Jersey, you were out of a job. And it turned out to be, I'm getting off on my own world here just a little bit, but maybe you find it interesting. So I found out I'm losing my job. And they said, okay, Smogula, come in here, pal. We need you to stay to teach the new people how to do everything in accounting. Now, that's not a fun thing to do, right? I'm teaching them. And they said, before you open your big mouth, if you're willing to do it, here is the severance deal we will offer you. And it was real good, believe me. You know, so it worked out to be a good break for me. I walked away with pretty good money. Anyway, the acquiring company treats the acquired assets and liabilities as if they had bought them individually. And the reason that's important, everybody, is that when you set up your new company, the assets and the liabilities are recorded at their fair value, not what you paid for them. Okay? And that could create what's called goodwill, which is an intangible asset. And we're going to talk a little bit about that. Okay?
Okay.
What are consolidated statements? The acquiring company is the parent. The company acquired is subsidiary. And the consolidated statements come into one particular statement. And we don't teach this in Accounting 230 here, but if you take a class called Advanced Accounting or perhaps Corporate Accounting, Nicole, you're going to learn all about eliminating entries. Remember, we talked about regular journal entries, and then you had adjusting journal entries, closing journal entries. Here, when you consolidate, you are going to have a lot of what is called eliminating entries. In other words, if the parent sold you something for $20, we have to eliminate that transaction because it's just between the two companies. And I always found that kind of interesting, although I never really did it in the workplace, but consolidated. Hey, goodwill. We have to do some goodwill hunting here if you're a movie buff, huh? Goodwill. It happens when you record a merger, not in a consolidation, but a merger. This occurs when one company buys another, and only purchased goodwill is an intangible asset. I'm going to talk about that in a moment. You might find that interesting and necessary for the test. What is goodwill now? Goodwill is the amount by which the purchase price exceeds the fair market value of the balance sheet you're buying, the assets and liabilities. Remember we talked about the land that we bought 50 years ago for $50,000 and now it's worth $1 million? Well, now another company just bought us. They are not going to debit their balance sheet for 50,000. They're going to debit it for 10 million or whatever it's worth today. And that's how we get to some goodwill. Okay. So this is a very quick look here. Let me just back up. Okay. Graham Holdings paid $1 million in cash to buy all of iNews. And they merged it. iNews no longer exists as a separate entity. The following information is available. Okay. The fair value of the equipment, the fair value was $350, and they had some intangible assets. So the fair market value was $950,000. That's what Graham is going to debit, $950. iNews might have only been carrying this at $200,000. Okay. So we are in a merger situation. We're going to debit everything for the fair market value. So we think that this company, their fair value of assets is this. When you buy the company, of course, you assume their liabilities, right? So we think this company is worth $850,000, but we paid $1 million for it. That difference is called Mr. Goodwill. It is an intangible asset. It is an intangible asset that you never amortize. You do test it for reasonableness and that it still holds that value, but you don't amortize it to zero like you do with a patent or a trademark, as we learned earlier, okay? So the goodwill, that's the goodwill calculation. Fair market value minus what we're paying for the place. So let's look at our journal entry. Well, we debited all their assets, right? We debited, pretend that this is, we debited accounts receivable, we debited equipment, we debited prepaid expenses, okay? Debited cash. Debit all the assets, but at the market value. Debit the patents at the market value. That's probably going to be what it was on their books. Well, we know we have to pay their $100,000 note, and we paid $1 million. We got the 150 by squeezing the number, right? 950 minus 1,100 is 150,000. So goodwill is kind of an interesting thing. This company was worth, the fair market value of this company is only 950,000. Actually, it was 850, right? Because you take out the 100. Why would this company pay $1 million if it's only worth 850? And it is only worth 850, but they still paid $1 million. Why would they do that? I'm waiting. Anybody else have an answer? No, what I'm getting at is,
I don't know. Maybe they're just nice. I don't know.
yeah, that could be. Yeah, that's right. Well, that happens a lot in the business world. The businessman will say, "I'll give you an extra 100."
They're just, hey, I'll just give you more money. No.
Let me spitball something else, if I may. No, you want to buy this company, and you go to the ownership and you say, "Okay, I'll give you 850,000. That's more than fair." And ownership says, "No, get lost. I want more than that." And you negotiate. And this company paid $1 million because they think if they get their hands on this company, they can really improve it. They've been looking at this company for years, and they're saying this management team doesn't know what they're doing. We could turn this $850,000 company into a $2 million company in no time. So that's why you would pay the $1 million. Okay. You could end up paying less. Somebody wants to get rid of the company. You know, a family business, a family corporation. It went from father to son. Now the grandson doesn't want anything to do with the business. He's not interested. He wants to get rid of it. So somebody comes to him and says, "Okay, I'll offer you 800." He says, "I take it," just to get out of it. So goodwill is not amortized. It is subject to impairment tests. In other words, are you still getting value out of that? Subject to impairment, and it can be written down. Okay, you ready? Investing in other corporations. How you got to understand this thing very clearly. How we invest? Is it a bond? It's debit. If we buy stock, how much is passive? How much is not? If it's my point is, this is just a little grid you can look at. I don't expect you to do anything other than use that as a guide. Maybe print it out and have it in front of you when you're doing homework.
Okay.
Well, it's what they're saying. Here's our flow chart. How will we invest? Is it a bond? Do we intend to hold the bonds? Yes, it's passive. We're done. How do we invest? Stock. Is it passive, significant, or common or control? If it's passive, is it treasury stock? I said it again, trading securities. It's just a way to kind of take your way through it, okay?
Okay. Wait, can you go back? I'm gonna take a picture of it.
Yeah, I think it's in your book. Oh, maybe it's not in your book, this one.
Just in case. And
by the way, do you have your book in front of you?
I don't. It's online.
Is that something you could look at right now while we're sitting here? The reason is I want you to find the page where they have a grid where they're laying out the journal entries for the passive investments. And that's a page.
And this is Appendix A, right?
Yeah, Appendix A. No more jokes about it. The appendix. The appendices.
Okay, so Appendix A, let me see if I could find a chart.
I can show you the page, but I think you'll see it. It takes up an entire page.
Am I looking for this?
Yeah, what you want to share?
Oh no, I'm just asking what do I look for?
Look for a grid, a matrix. It'll show trading securities in the one column and passive investment, trading securities in one column. The third column will be SARs. And on the left, it'll show you the journal entries. And you'll see that the journal entries are exactly the same up until the very end. Then at the bottom, it shows when it hits the income statement. Hold on a second, Nicole. Let me show it to you.
Okay, I'm looking while you're doing.
Uh-oh.
There's organization of the appendix.
My 4-year-old nephew was very angry. I told him he's out of my will. I said, I don't care if you're 4 years old, Nico. You're not going to go that political. I don't care what your preschool told you. Okay, I'm getting close. I'm getting hot here. Here it is. It's A10 on my book. Can you see it here?
A10. Okay, let me go. A4. Oh, this book is just so nice. A9. Okay, A10.
You see the exhibit A2, comparison of accounting for trading securities? I don't know if it would be, this is the page. I don't know if you can see it through the screen here.
I don't have that one. Oh, yeah, I do.
Yeah, you do.
I think.
Anyway, that's a good thing to have in front of you when you're doing your exercises and homework, okay?
Okay.
You notice that everything is the same. The only difference is at the very end where under the SARS method, you see things hitting the income statement every period. Trading, you don't hit the income statement until you sell it. That's all.
Okay.
Cash flows. Cash flows. Well, this is, you know what this is? This is just a trailer for the next chapter because the next chapter is on cash flows. All right.
Okay.
So that's a look at Appendix A, which this used to be a full chapter in the book. I don't know why they turned it into an appendix. When the publisher did that, it screwed up all the teachers because we had all these chapters built into our, into our programs. And now you go into chapter 12 thinking it's going to be the appendix, and you got the wrong thing now. So, but any kinds of questions right now, Nicole? Is it too early to digest what we talked about?
I think I got it.
Yeah, I think you'll get it. I think the class
do the homework, but
okay.
Yeah, I think I got it. Yeah, I think I got it. If not, I'll be on tutoring in a little bit.
In our last session, my computer conked out. The battery was
dead.
I
know. I emailed you. I'm like, it logged off. Good night.
Did you see those two guys though I showed you?
I still have it open on my thing.
You don't have to do it now, but back in the Northeast, the Italian American community was very offended by those two guys.
Yeah.
Portraying themselves as mafia hitmen. Participating in my favorite sport, okay? Yeah. All right. Well, I'll let you go, pal, okay?
All righty. Thank you.
And you know where to find me tomorrow if you need me. I don't want to use the word stuck, but I am.
You do tomorrow? Yeah, right?
Noon tomorrow.
Oh.
And then I have another class at 3 tomorrow Saturday. Yeah, I got a class at 3 tomorrow on the same subject. So, all right. Well, we'll catch you later. Okay.
Alrighty, have a good one.
Hey, you too. Bye-bye.
Thank you. Bye.